Imagine having a business partner who changes moods every single day. One morning, he's thrilled, telling you everything is worth double what it was yesterday. The next, he's anxious and desperate, ready to sell his shares for half their value. Would you trust his judgment? Would you let his emotions guide your decisions? That's exactly how the stock market behaves. It's unpredictable, driven by fear and greed. Millions of people jump in hoping to get rich fast, buying high when excitement peaks and selling low when fear takes over. And most of them fail. But a few, those who understand the game, win consistently. They don't follow the crowd. They follow principles, time-tested rules that protect their money and multiply it. This is what Benjamin Graham, the father of value investing, teaches in The Intelligent Investor. His book isn't about chasing quick profits. It's about building real, lasting wealth, the kind that stands the test of time. Investment versus speculation. The first thing Graham makes clear is that there's a huge difference between investing and speculating. Investing is like owning a business. You research it, understand its strengths, and buy it for the long haul. Speculating is more like gambling. It's betting on price movements without really understanding what you own. Most people in the market think they're investors, but in reality, they're just speculators. They follow the latest stock tips, jump into trends, and hope to make a quick profit. Graham warns against this mindset. The stock market rewards those who think long-term and punishes those who act on emotion. The question is, are you investing wisely or are you just hoping for luck? The defensive investor. Not everyone wants to spend hours analyzing stocks. Some just want a safe, reliable way to grow their money without taking on too much risk. That's where the defensive investor comes in. Graham's advice for these investors is simple. Don't try to be a genius. Instead, focus on consistency and safety. Defensive investors should put their money in strong, established companies. Companies that have been around for decades, consistently making profits, paying dividends, and surviving economic downturns. They should also diversify, spreading their investments across different industries to minimize risk. And most importantly, they should avoid chasing trends. The goal isn't to make the highest returns, it's to protect what you have and grow it steadily over time. The enterprising investor. For those willing to put in the work, there's another path, the enterprising investor. This approach isn't about luck, it's about effort, discipline, and knowledge. Enterprising investors look for stocks that are undervalued, companies that the market has ignored but have strong financials and future potential. They analyze earnings reports, balance sheets, and market trends, searching for hidden gems. It takes time. It takes patience. But this is how great investors like Warren Buffett made their fortunes. They didn't chase hot stocks. They bought undervalued companies and held on to them until the rest of the world caught on. If you're willing to put in the effort, this approach can lead to extraordinary results. But if you're not, it's better to stick with the defensive strategy. Mr. Market allegory. One of the most powerful lessons in The Intelligent Investor is Graham's metaphor of Mr. Market. Imagine you own a business with a partner named Mr. Market. Every day he offers to buy your share of the business or sell you his. But here's the catch. He's completely irrational. One day he's euphoric, pricing everything at sky-high values. The next he's depressed, selling at bargain prices. Most people react emotionally to Mr. Market. When he's excited, they buy, fearing they'll miss out. When he's scared, they sell, terrified of losing money. But the intelligent investor does the opposite. They don't let emotions dictate their decisions. Instead, they take advantage of Mr. Market's mood swings. They buy when he's fearful and sell when he's overly confident. The stock market is full of emotional reactions. The key is to stay rational. Margin of safety. One of the most important principles Graham teaches is the concept of the margin of safety. Think of it like building a bridge. If a bridge is designed to hold 10 tons, engineers will build it to support 15 or 20 tons just to be safe. That extra weight capacity is the margin of safety. In investing, this means buying stocks at a price lower than their actual value. If a company is worth $50 per share, but you buy it at $30, you've created a safety net. Even if something goes wrong, your downside risk is minimized. Without a margin of safety, investing becomes gambling. You're relying on everything going perfectly, And in the stock market, things rarely go perfectly. This simple rule, always buy with a margin of safety, is what separates smart investors from reckless ones. Market fluctuations and timing. There's a common belief that you can predict where the market is heading. Many people try to time the market, jumping in and out based on the latest news, charts, and expert opinions. Graham warns against this. The truth is, no one can predict the market's short-term movements consistently. The best investors don't try. Instead of trying to guess market tops and bottoms, intelligent investors focus on finding good companies at good prices. If you buy quality businesses and hold them for the long term, market fluctuations won't matter. In the short term, stocks go up and down based on emotions. In the long run, they reflect real business value. Stock selection criteria. So how do you actually pick the right stocks? Graham provides clear guidelines. Defensive investors should look for large, financially stable companies with strong earnings and a long history of paying dividends. Enterprising investors should dig deeper, looking for companies with low debt, solid earnings growth, and undervalued stock prices. The key is to focus on quality and value. Many investors fall into the trap of chasing what's hot, but the best opportunities are often in places no one is looking. The role of inflation. Inflation silently eats away at wealth. A dollar today won't buy the same things in 10 years. That's why holding too much cash is a losing game. Graham emphasizes the importance of owning assets that grow in value over time, like stocks and real estate. While inflation erodes purchasing power, businesses can adjust prices, making stocks a strong hedge against rising costs. The biggest mistake people make is thinking that saving cash is safe. In reality, cash loses value. The only way to truly protect wealth is by investing it wisely. The intelligent investor's mindset. Beyond numbers and strategies. The intelligent investor teaches a mindset. The best investors control their emotions. They don't panic when the market crashes, and they don't get greedy when it rises. They think long-term and stay disciplined. Graham emphasizes independent thinking. Just because everyone is buying something doesn't mean you should. The crowd is often wrong. Intelligent investors make their own decisions based on facts, not emotions. Most people lose money in the stock market not because they pick bad stocks, but because they let emotions control their decisions. Practical applications. The principles in The Intelligent Investor aren't just theories. They've been proven time and time again. Warren Buffett built his fortune using Graham's methods, buying great businesses at good prices and holding them for the long term. Many other investors have followed the same path, proving that these lessons work. The question is, will you apply them? Investing isn't about luck. It's about discipline, patience, and rational decision-making. The market will always go up and down, but those who stick to sound principles will come out ahead. So what kind of investor will you be? Will you follow emotions and trends, or will you think like an intelligent investor? If you found this video valuable, hit the like button, subscribe to the channel, and turn on the notification bell so you don't miss our future content. And let's talk. Drop a comment below. Are you investing wisely, or are you just starting your journey? Let's discuss.